Are you a buyer in 2022 that feels like you've been priced out? Is home ownership and affordability slipping through your fingers? If you're a buyer or a realtor, I'm making this video for you to talk through some of the strategies we're using as interest rates creep up, as affordability starts to feel out of reach. These are the conversations we're having with clients and realtor partners day in and day out. Watch this video. Hopefully you find it useful. All right, Matt the Mortgage Guy, residential mortgage broker. We help people buy homes and we strategize with our realtor partners and referral partners to help structure a loan that makes sense for clients. In this environment, with interest rates going up, with the affordability and quite frankly, the mortgage payment getting kind of uncomfortable for folks, it's more important than ever to strategize and structure the mortgage, which the good news is we can, right? We've got seller concessions. We've got the ability to negotiate. So before I jump into it, if you want to connect with me and my team, greatmortgagebroker.com, fill out that form. Me and my team will be in touch. We're happy to help. We're licensed in 44 out of 50 states, soon to be 50. If you want to connect with an agent who's in your area, go to homeandmoney.com/Matt. If you're in Sacramento, connect with our team personally, and we'll connect you with an agent here. But let's get into what I want to talk about, because I'm seeing a lot of my clients have success with this. And I think that this is a conversation I want to have with more realtor partners, and a conversation I want to make sure clients are having, even if you're not working with us, conversation you should be having, right? As interest rates go up, I know some people look at these 6.75% interest rates that some people are being presented with, and they're just saying it doesn't make any sense. Well, if you talk with the realtor partners, every market is different. In our market currently, getting 1%, 2%, and 3% in seller concessions is not that hard. It's all in the negotiation, right? The seller's asking $525. They've been on the market for 24 days. We might offer them $520 with 3% in seller credit. Now, if they want to sell this house, they're going to consider that, right? And so every day we're getting into contract, 2% seller credit, 3% seller credit. And I'm going to give you specific examples so you can see what that means to the monthly payment. Because a lot of folks don't understand that offering $510 with no credit or $505 with no credit is a much bigger payment for you, the buyer, than if you offered $520, got a big credit that was able to buy the interest rate down, right? Using that seller credit to buy the rate down versus maybe getting a slightly lower price, which in the end, the seller net can be the same, but for you as a buyer, it's going to be a much lower payment. Let me kind of dig into the numbers and I'll explain. If you have any questions, feel free to hit us in the comments. I'll try to answer as many of those as possible. If you took a scenario where you were putting 10% down, and I know that I always use big numbers, so I try to go conservative and just say 389. I think 389 is the newest number for median home price across the US. 389,000, 10% down. If somebody were to do this today and they had a decent credit score, they might see a 6.75% interest rate. Now, that might change next month or a month after. So depending on when you're watching this, that may or may not be relevant. But that payment, principal, interest, taxes, insurance, and mortgage insurance for a $350,100 mortgage, $389 purchase price with 10% down, is $2,799, $2,800 a month. What we would coach both the real estate agent and the client is, let's ask for 2% or 3%. At the very least, maybe we get 1% in credit. With 1% in credit, you can probably buy it down to 6.375. That would be a $2,712 payment, almost $100 cheaper. If you got 2% in credit, and we're able to spend 2 points to buy down the interest rate, keep in mind, when you get a 2% seller credit, you're getting 2% of the sales price, so almost $8,000. For 2% of the loan amount, which is $7,000, you're able to buy that rate down to 5.875. You can use that extra $1,000 to offset other costs with the loan. title fees, prepaying your tax and insurance. But that's not the point of this video. The point of this video is to show you at 5.875 with the same purchase price, you've got a $2,599 payment, exactly $200 less than if you took the 6.75. Now, it would be a break-even analysis if it was your own $7,000 and you would say, I'm spending $7,000 to save $200 a month. It's a 35-month break-even. Should I do it or should I not? If the seller is paying that, it becomes an easier decision, right? It's not like, am I going to stay in this house for more than 3 years? Take it to the extreme and 3 points. This is a law of diminishing returns. So that next point, that next $3,500 only buys you down to 5.625, and that's $2,543 a month. So that's, what is that? $56 more. So that one might not make sense. But these are the conversations. You're having a conversation with the loan officer and saying, what do you think I should do? And it might be, hey, listen, $2,600 is a comfortable payment. Let's do that. Even if you get 3% in credit, we'll use the extra credit to offset some of the closing costs, keep more money in your pocket. And that way your cash to close is less. You're able to have a little emergency fund in the bank, all these things, right? These are the conversations that are more important than ever. 6 months ago, 9 months ago, plug and play, 2.875% interest rate, 3.25% interest rate, $2,100 payment. Everything's cheery, right? More and more, I'm having the client conversation. I want you to be in a comfortable mortgage payment. I want to be part of the dream. I don't want to be part of the nightmare. I don't want you to stick a $3,500 mortgage payment. It's going to make you uncomfortable every month. That's going to make home ownership, be something that causes knots in your stomach, right? We want to structure this in a way when you're ready, not when the market's ready, not when interest rates are ready, but when you're ready. Your credit's in order. You've got a down payment. You got a little money saved for an emergency fund. You feel good about your job. That's stable. Your time to buy. Forget about the other stuff. Now let's get to work on structuring a mortgage that works for you. Hopefully this was helpful. I'll try to add some screenshots. I'll try to add some stuff there. Comment below if you got any questions at all. Like I said, we're more than happy to help. Go to greatmortgagebroker.com, fill out the form, let us know how you can help. If you're a realtor partner and you want to chat with us about working with your clients so we can do the same for you and your clients, structure a deal that makes sense for them, please reach out to me. And if you are working with us or with somebody else, make sure that your realtor and your lender are communicating. These are the conversations that should be had. These are the conversations that, as a team, your realtor partner and your lender are going to work together to find a house that works in an area you like with the right monthly payment that you're comfortable with. That's how you make home ownership a reality. Hopefully this was helpful. So until next time, we gonna see.